Banks continue to fail, and Third Republic now becomes the third one in the last 3 months. The underlying problem of the banking failures has not been corrected, so we might continue to see banks fail. If you want to learn more about why this is happening, you can check out this other video here where I go into detail. In this video, I want to focus on what this means for us, the average consumer. And some of the topics that we'll cover in this video: number 1, is your money safe? Number 2, what happens to your mortgage if your bank goes under? Number 3, should you invest in individual bank stocks? Number 4, are taxpayers going to pay for this again? Number 5, is the Fed partly to blame? And lastly, we'll talk about interest rates and whether this will impact the Fed's decision to continue to increase them. So let's go. Let's jump right into it. The number one question people may have is our money safe in the banks, and are we guaranteed to get our deposits back? Fortunately for consumers, the FDIC was created for exactly this purpose. During the 1930s, 9,000 banks failed and millions of Americans were at risk of losing their money. This led to the Banking Act of 1933 and the creation of the FDIC. The FDIC stands for Federal Deposit Insurance Corporation, and they essentially act as an insurance policy in case banks were ever to fail. The maximum insured limit right now is $250,000, and they insure a wide range of accounts. These accounts include checkings accounts, savings accounts, money market deposits, certificate of deposits, money orders, and cashier's checks. It's important to note though, this does not apply to stocks, bonds, or annuities. But in the case of these assets, you are still the primary owner, and that will never change. These assets might just be transferred to another banking institution, but you will still remain the full owner of these assets. Overall, your money is guaranteed to be safe up to $250,000. But if the failure of Silicon Bank taught us anything, the maximum limit might actually be even higher. 97% of deposits at Silicon Valley Bank were uninsured, yet the FDIC made sure that everyone had access to their money. The safest way to insure your money, though, is to spread out the money across multiple bank accounts if you exceed that $250,000 limit. For example, let's say you needed to insure $500,000. What you could do is open up 2 separate bank accounts, for example, at Chase or Bank of America, make 2 separate checking accounts, and put your money there. That way, each bank will have $250,000 of insurance, and in total, you'll have $500,000 of insurance personally. Now, most of us probably don't have this much cash sitting around, so we're never going to come close to that $250,000 limit. The second question you may have: what happens to your home mortgage if the bank were to fail? There's a couple of different scenarios that might play out. The most common one is your bank will probably be absorbed by a larger financial institution. This is the exact scenario that happened with First Republic Bank. The FDIC seized First Republic Bank and brokered a deal with JP Morgan where they would take over all of their assets. In this case, the homeowner may have a new bank to report to, but the actual terms of the mortgage, they remain completely unchanged. Nothing really changes for the consumer. You'll still have the same monthly payment, the same interest rate, and the total length of the loan remains the same. It's worth noting though that even if the bank does go under though, you are still responsible to make your payments on time. If you do fall behind on your payments, you would still be at risk for a foreclosure. So in the case that your mortgage lender goes down, make sure you know who the new lender is and where to make those payments. And just to be clear, this is not financial advice. If you have any individual questions about your own mortgage or your own personal finances, please speak to your own personal bank representative before making any decisions. Number 3, what will happen to individual bank stocks during a banking crisis? We can actually learn a lot from history, so let's take a look at 2009 to better understand what might happen today. In 2008, Washington Mutual was the largest bank to fail with approximately $386 billion in assets. And this is what happened to their stock. Peaked at $52.92 and eventually dipped all the way to zero. And if you look at what's happening today, this is very similar to what happened to First Republic Bank. And this is a chart of First Republic Bank. As you can see, their peak price was approximately $200 at the beginning of 2023, and over the course of just a few weeks, their share price plummeted from $200 all the way down to $8. And now that FRC has been seized by JP Morgan, these shareholders are essentially out of luck and they've suffered permanent losses. And just to put this into perspective, we should compare it to the banking sector as a whole to see how they're doing. There's an index called the KBW index, and this accounts for the top 21 banks in the United States. In the last 6 months, this index is down approximately 30%, and they're down 50% if you compare it from the very top in 2022. Overall, the banking sector as a whole will likely recover, but if you're trying to pick individual bank stocks, it's kind of like playing Russian roulette. There may be only 1 to 2 bullets that could really hurt you, but if that does happen, you're gonna suffer huge losses. For me personally, I don't have a huge stake in the banking sector, but I am interested when things settle down. For now, I'm going to stay out of it, and I'll keep an eye on the index to see what's happening. Number 4, are the taxpayers on the hook again, similar to 2008? In the 2008 financial crisis, the taxpayers were the ones to eventually bail out these banks. The federal government created a program called the Troubled Asset Relief Program, which was essentially a $400 billion loan from the government designed to keep these banks in operation. Proponents of TARP argued that this was a necessary measure in order to prevent further collapse of the financial system. In total, the TARP program ran for 4 years between 2009 and December 2013. In total, the government loaned out $426 billion after everything was said and done. Critics will say this might not have been necessary in the first place, and although it saved the banks from going under, it did little to save the housing sector where millions of Americans were defaulting on their home mortgages. A total of 3.1 million homes were foreclosed in 2009, which means 10 million Americans were without housing. So how come individual banks were saved, but individual homeowners were not? I still don't have an answer to this question. If the government was willing to lend money to the banks, why were they not willing to lend money to individual homeowners to also maintain their homes? Personally, I hate this idea of too big to fail, because this just gives organizations a free ticket. They can essentially take on as much risk as they want and know that eventually the government might bail them out. And that brings me to my next point. Is the government partly to blame for the current banking crisis? As we saw in the 2008 financial crisis, the structure of banks not only affect day-to-day operations for the banks and their profits, but they also affect millions of Americans. The Dodd-Frank Wall Street Reform and Consumer Protection Act was enacted in 2010 in response to the 2008 financial crisis. The goal was to prevent another financial meltdown. This act introduced a number of regulations aimed at increasing transparency, accountability, and stability in the banking sector. This meant that there were more regulations in place, especially for banks that were quote-unquote too large to fail. One of the key terms in this bill was defining systematically important financial institutions, essentially banks that were too big to fail. And this had been defined by any bank that had more than $50 billion in assets. In 2018, President Trump made some changes to these regulations. He passed a bill known as the Economic Growth, Regulatory Relief, and Consumer Protection Act. The most important change was the threshold at what a bank is considered to be too large. Instead of being $50 billion, this was designated to be $250 billion. And the problem can be most evident with Silicon Valley Bank. Silicon Valley Bank was valued at $209 billion, which was technically an institution that was too large to fail. But with the 2018 rollbacks, they were no longer deemed to have this designation. So now they had fewer regulations. After Silicon Valley had gone down, the Fed looked into what went wrong, and this is what they said. Supervisors were slow to grasp the extent of the problem, and when the problems were identified, supervisors failed to move aggressively enough to ensure these problems were fixed. And another direct quote from Michael Barr: "Following Silicon Valley's bank failure, we must strengthen the Federal Reserve's supervision and regulation based on what we have learned." So yes, the government probably played a role in some of these bank failures. In addition, inflation is not helping. We saw record levels of inflation in 2021 and 2022, and the Fed was forced to increase interest rates. This put banks under a lot of pressure, and that's also part of the reason why they're struggling. And this brings me to the next point. Will the Fed continue to increase interest rate? At the most recent Fed meeting, they increased it again for the 9th straight time for another 0.25 basis point. And although the Fed probably wants to increase rates more, they have to be careful because they're putting a lot of pressure on the banking sector. For many months, the Fed has been using strong language about the necessity of increasing interest rates. But at the most recent meeting, they've started to change that up. Their previous statement included a phrase that said, additional rate hikes might be needed, and now this has been replaced with a phrase that says, we will have to weigh a range of factors in determining the extent of which future hikes might be needed. And even though this is subtle, this represents a huge change in the way the Fed is approaching inflation. They're essentially trying to tell us they're not sure what they're going to do at the next meeting. Overall, it's anyone's guess whether they'll continue to go up, but I don't foresee them going down anytime soon. Inflation still remains a problem, and until that's under control, the Fed is going to be forced to keep these high interest rates. We covered a lot of information in this video, and if you have any questions, leave them in the comments below, and I'll try my best to answer them. And if you like this video, please subscribe and consider leaving a comment. Tell me what I could do better or what you liked about it. Anyways, hope you're having a great day. See you guys next time. Peace.